introduce Rex Frazier. In the email I sent out, I did put a link to his bio, but he's president of the Personal Insurance Federation of California, and represents their member companies before California state government, provides advice on legislative, regulatory, and litigation and political matters. Previously, he was vice president and general counsel of PIFC. So with that, Rex, I'll turn it over to you. I'll ask everybody to stay muted and hold your questions until after Rex presents. And if you want to give any more of your background, go ahead, Rex, it's yours.
Thanks for having me. And Rick, I'm okay if people just want to use the function to say they've got a question during the presentation. It's no problem at all. I find that if I hold my questions to the end, a lot of times I forget what I want to ask. So up to you all how you want to do it. Maybe I could share a presentation, and hopefully we can make this work. Did that work, everyone?
Yes.
Amazing. Alrighty. As Rick said, so I represent the largest insurance companies in the state, and so I'll give a little background on that. But my background is, prior to this position, which I'm just about to finish my 19th year at the Federation. Prior to that, I was a regulatory attorney in Los Angeles, working on bank and insurance regulatory matters. And prior to that, I was a deputy insurance commissioner at the California Department of Insurance, and worked there for, I guess, a little over 6 years, right after the passage of Proposition 103, which was a ballot measure in 1988 that I'll describe a few of its key legal provisions. But boy, we were just trying to figure out, what do we do? There were 75 lawsuits challenging the ballot measure, and how do you implement it? It was a heady time for a young person. But today, hopefully I'll give you a little background on PIF, go through a few of the key legal provisions that I think are really driving some of the dynamics that we were talking about prior to the start of this. I'll give a little perspective of the way insurers have viewed the market, and then those views have changed. And then we can get into really what are the key 3 issues that I think have to be fixed before the market's going to demonstrably improve. We'll talk a little in the FAIR plan is a key issue there. Talk a little bit about the new attention of rating agencies on the FAIR plan, and then really talk about what has to happen in the future. We'll talk a lot about rate increases in the short term, but that's obviously not a long-term solution. We can't get to the point where insurance is simply unaffordable, and some mitigation is really our longer-term strategy. That as much as we would love for mitigation to have instant impact, that is a long-term strategy that it's difficult to execute the community level projects that are probably going to be needed. Okay, let's see if I can. So with that, these are the folks that I work for. So roughly 74% of the homeowners insurance market share sold in California. You'll recognize most of these companies. The top 12 insurance companies in the state, measured by who writes at least 2% of the market, write 84% of the market share. Just 5 years ago, that was about 81%. So as market conditions have deteriorated, a lot of the smaller companies have either, they've been forced to restrict. They just don't have the capital to keep losing money the way the larger companies can withstand these periods of profound loss. And so as a result, the market share has shifted and consolidated to become more heavy in the largest companies. So in thinking about where we've been and where we are now, there's really 3 three provisions of the law that they are what they are. They're not going to change. And, we certainly just accept them as this is part of our reality. One is, as I mentioned, in 1988, there was a ballot measure that instituted what was called, it's called Proposition 103. We had it created the elected insurance commissioner. Prior to that, dating back to the 1860s, the insurance commissioner was an appointee of the governor. And so in 1988, by ballot measure, we changed that. So we had the first elected insurance commissioner in 1990. That does change the tenor of conversations between insurance companies and the state. Some good, some bad, but it's definitely a mixed bag in my experience. But also, in addition to the elected insurance commissioner, we for the first time had what's called prior approval rate making. And all that means is that in the previous system, a company, it was called file and use, and they would just file, hey, I'm changing my rate. It could be a rate increase, it could be a rate decrease. They would just notify the state and then institute the change in the marketplace. That's no longer the law in California. Before a company increases or decreases, the rules are the same for both. Its rate level, it has to go to the Department of Insurance and submit really the most detailed rate filing in all of the country. Our filing requirements are quite heavy here. And then the Department of Insurance, through its rate analysts and actuaries, and sometimes lawyers, will commence a rate review, it's rigorous, which I think some people will like because they want to say, let's keep those bad insurance companies honest. The downside is it takes a really long time to get through that process, and there's some consequences that come with that. Secondly, the ballot measure allowed outside groups to participate in the rate filing process. They're typically lawyer groups, and they're able to become a party to these rate filings. So then the insurance company not only has to negotiate with the state and its rate experts, but it has to deal with these law firms. And they're treated like a party. They have to be involved in all discussions. And obviously 3 parties is just more complicated than 2. It increases difficulty of scheduling. You have more opinions, and it does have an impact on the process. Those companies are able to qualify for compensation that the insurance companies do pay them, and then add those costs into their rate filings. And so they do pass those costs along to customers. And then lastly, we have what's called the California Fair Plan Association. That's not a government program. I hear a lot of people characterize it that way, but that in statute, it's called a non-voluntary association of private insurance companies. So for an insurance company to operate in California, they must join the California Fair Plan. It's not an option. And that therefore means that companies are subjecting themselves to the rules of the Fair Plan's plan of operation. And the important thing there is the Fair Plan is operated as its own insurance company. It files rate filings just like regular companies do. However, it's not held to the same capital requirements. So the Fair Plan can just write indefinite amounts of fire insurance. And if they don't have the money under normal rules, they're allowed to write anyway. And when they run out of money, they just turn to the insurance companies and say, hey, on a market share basis, give us the money we lack. So if they're $1 billion short, they turn to State Farm and say, hey, you guys write 21% of the market, write us a check for $210 million. Thank you very much. And that just comes out of State Farm's, in that example, it would come out of their unreserved capital. It would come out of their surplus. And there's significant consequences that flow from that type of system. So the Fair Plan, while in the short term, it does provide a guaranteed method of satisfying a lender requirement for fire insurance in order to get a mortgage. It's certainly not a place where anyone should want to be, much less to be there for a long period of time. But it does satisfy an important requirement in the short term, which is to have a guaranteed issue of fire insurance. So, um, moving on, this is sort of a tale of where we've been, and and you, this chart, hopefully, it's sensible to you. This is an industry-wide underwriting profitability chart, meaning that when you see a yellow bar, that means in that year the industry as a whole lost money on their insurance business. If it's a green bar, that means the industry as a whole made money. And then the blue line tracks the cumulative result. And so you can see from 1991, really to about 2003, homeowners was a pretty predictable business. Insurance companies generally lost a little bit of money on their business result, but then the way the law works, that you take in that premium dollars and then you invest it. And so once you have your investment income, then you can generally hit your profitability targets. But when people tell you, oh, it was an up year in the stock market and insurance investment portfolios went up, the way it works in the rate formula is the more investment income a company makes, the less they're allowed to charge on their rate. The worse investment results they have, the more they're able to charge in their rates. So it's not as if it's just windfall. Investment returns are considered in the permitted rate level under Proposition 103. So you can see through 2003, pretty predictable. And then we went through a period of just solid profitability for insurance companies. And so you can see all those green bars, what's that, starting in 2004, all the way up through 2016. And so that blue line starts to look really good, right? Year after year, profitability for the industry. And so what that meant is during that roughly, 12-year period, insurance companies were pretty much prevented from being allowed to charge a much higher rate. The way the rules work, if companies are generally making profitability at their current rate level, they can't just go to the state and say, hey, I'd like to charge more. Even as some companies in 2013, 2014, 2015 started worrying about the number of homes they were starting to insure near fuel, near brush and near trees, they were starting to better understand the impacts of climate change. There were companies in 2014, 2015 that were begging the state to increase their prices. And the state looks at this chart and just says, no, you guys are making plenty of money, go away. And so that system, it worked until it didn't. It worked until we had 2017. And we had those massive fires in both Northern and Southern California. And you see that one long yellow bar. One fire season in 2017 eliminates the underwriting profit dating back to 1991. And I will say that didn't really change the market. Companies were like, wow, that was really scary. But at the same time, that's why they squirrel this money away. That's why they build their capital reserves for a catastrophic class of business, for wildfire related risk. That's their job. So the market didn't really change. When 2018 hit, that's when market participants started to question, do we really adequately understand what we're doing here in California? Has something fundamental changed? Whether it's a changing rain season, because we started to see a delayed onset in precipitation in the fall. So we had longer periods of dry vegetation with no rain coming in, and we get the Santa Anas and the other seasonal winds that are predictable, Diablo winds in Northern California. And we would go from basically a month of hot, dry winds and dry conditions to upwards of 2 months. And I think companies started to say, is this how climate change manifests, at least in Northern California and maybe Southern California, through a change in rain pattern? And companies started to question whether they understood how to adequately price and underwrite wildfire-related risk. And so, since then we've had some luck. We continue. We certainly had some luck last fire season. And so companies are starting to dig out now. But when they started paying these massive losses in 17 and 18, they already felt like they were in a hole. They had been held down for a pretty significant period of time in what was then, remember, we had a low inflationary environment for a very considerable period of time with interest rates that are just unthinkable. And, so companies' average premium levels just simply didn't increase for a significant period of time. During this time, this is a study from the state's climate change assessment. The state does a periodic climate change assessment. I think Cali PA might be the one that does it. I can't remember. But this was they in their fourth one. I think they hired the Rand Institute to do sort of an insurance module for the first time. So that was interesting for us to see their study. But what they documented is that insurance companies, through adoption of satellite technology, got a whole lot more discerning in how they look at high risk versus low risk. Excuse me. And this was a study from the Sierra foothills. And what it shows is that in low risk areas over the study period, premiums actually went down for a lot of people, and they were offset by, in high risk areas, premiums went up. The way the rate rules work is a company gets permission to charge a certain amount of money on an aggregate statewide basis. So if they want to charge someone more, they offset it by charging someone less, remember, because you can only charge a certain amount. Okay, so companies get permission on how much they can earn on a statewide basis, but have a lot more flexibility in how they allocate that premium to different policyholders. So in an example, let's say everybody, the company had permission to charge everybody $100 a year. Well, but they're not going to do that. They're going to charge some people $105 and they're going to charge some people $95. It all has to balance out so that it averages $100. But what the study certainly showed is in urban areas, we've seen moderate to even reduced premium, and in higher areas we've seen shocking premium increases. And under Proposition 103, the way the law reads, it says no rate shall be inadequate, excessive, or unfairly discriminatory. And so there's a prohibition on insurance companies making one policyholder subsidize another. And so you can see, the impact in a chart like this. And it's a hard issue. Typically people who are going to live in more remote areas with higher fire risk, they're not making the big dollars of living in a big city. So they're already going to be income constrained. And should the state be worried about, well, can we let premiums get so high in areas where you probably have a lower income? Well, that's certainly something for the state to consider, but the insurance law, the way it works is the insurance companies are not supposed to consider that. Insurance companies are supposed to charge what is actuarially indicated. So where are we in comparison to other parts of the country? I know this will probably displease some people, on this Zoom, and I'm happy to have you throw darts at me. I'm used to it at this stage of my career. But California is a relatively low average premium state relative to the rest of the country. Now, of course, there's going to be examples of people having humongous quotes that are higher than $1,241 a year, of course. But on average, and mind you, this was in 2020. I wish I could give you more up-to-date numbers, but the National Association of Insurance Commissioners that puts out this report, they certainly take their sweet time in collating the state-by-state comparisons. But what this documents is over the 10 years in here, California appreciated or California experienced average premium growth just like every other state. It was less growth than in the rest of the country. And there's a couple important takeaways from this chart. In the hurricane areas of the Gulf that have already been dealing with massive storms, really dating back to 1991, when a storm bankrupted 6 insurance companies in one event. We've already had sort of a market adjustment in the Southeast for a very significant period of time, so that even in a relatively low average income state like Louisiana, The average is much higher than California. And of course, it takes a whole lot more money to repair a home in California than it does in Louisiana. This is unadjusted for income, right? Once you say, what's the price of insurance in Louisiana versus California? When you look at the average income in both states, where our average income here is very much higher than Louisiana, the price of insurance in California plummets to it's the cheapest except Hawaii. That's the only state that when you adjust it for income is cheaper than California. So, the price controls in Prop 103, they've done what the proponents of Prop 103 wanted. They've kept a lid on average premium charged in California. And I know some will certainly cheer, see, we did what we promised. But then they conveniently ignore the consequence of what they've done. Because I don't know any business that if you put a lid on how much they can charge, when costs start to go up, I don't know any business that just said, I'm just going to keep doing business as usual and I'm going to keep losing money. It's not going to happen. So in the short term, there's no doubt about it. The average premium in California is going to rise. And that is the short-term strategy, to get companies to have enough capital on their books so that they're able to stay in the market, and then we can start talking about hopefully resuming growth. And as I said at the outset, I don't think that's the long-term strategy. We've got to have a serious discussion about mitigation, particularly community mitigation, that's going to make a lot of people unhappy when we start thinking about what type of fuel reduction we're going to need in various communities to make those communities more insurable. But in the short term, average premiums are going to rise in California. And if they don't, we're just going to have less supply by these insurance companies. That's going to make the FAIR Plan grow. And in a few minutes, we'll talk about the risk that the FAIR Plan presents to take the whole system down. So before I leave sort of these facts and figures, I'm happy to take any questions or any barbs or darts that anyone wants to throw. No, I already bored you? Yes, Stu.
Yeah. So one of the things that strikes me about this whole situation, and I'm not sure how strong or good the analogy is, but it strikes me as there's some analogy to be made with flood insurance. And particularly that, there's coastal areas, and there's also in areas along some rivers, in places like West Virginia, where there's a lot of flooding and homes just get wiped out every 10 years, every 15 years. And the way it works is people just go ahead and rebuild with their flood insurance. But I think, isn't flood insurance also having a problem in terms of the insurers saying,
Yeah.
you can't get flood insurance some places?
Well, you can definitely get flood insurance, but your analogy is a good one, but there's a key difference. So the flood insurance is mostly written through the federal government, through the National Flood Insurance Program, the NFIP. So insurance companies service those policies, but the financial risk is undertaken by Uncle Sam. So the NFIP is 100% backed by the US Treasury and presently has over $20 billion of loss that the US Treasury has eaten. And so, we don't, these insurance companies don't have a government backup here, right? So when they start losing money, they can't just say, "Oh, let's keep it rolling." Whereas certainly in the NFIP, particularly in, let's say a bunch of states or a bunch of homes on the Mississippi River dealing with storm surge, and you've got these big hurricanes that come in and those homes get washed away, you can, get your flood insurance benefits and then you can rebuild in the same area.
So I'm wondering whether on both the flood insurance and for fire insurance, and maybe other things as well, earthquake insurance. I think in California, of course, we've already got some of that, but maybe there needs to be some thought about maybe there are places you shouldn't be allowed to build, and maybe in some places you buy out the people who are living there and say, no, you can't live here anymore. We're going to pay to get you out of your house and move elsewhere.
Yeah, this is a thorny issue, and I think we've struggled with how to be a responsible voice on just this topic. Insurers typically, they don't want to tell communities what they should or shouldn't do. They don't want to tell homeowners associations what they should allow, or city or county governments. The insurers view their role as signaling the risk that comes with those decisions. And then the community can live how it wants to and how it wants to govern itself. There was one development down in East San Diego County where we knew it was going to be really hard to insure that area. And we did speak up to the Board of Supervisors and say, are you guys sure you want to permit this development? Because pretty soon people aren't going to be able to get insurance and they're going to be yelling at us. And we at least wanted to be on the record in advance to say, think about what you're doing. But that took an extraordinary level of discussion among our membership to weigh in like that, because we don't want to tell elected supervisors, how to run their communities.
But maybe the government can.
Well, you certainly have legislation regularly introduced now that 5 years ago you wouldn't see, questioning whether development should keep moving further out. At the same time, as we were talking earlier about what the HCD did in your area, you've got these RENA requirements, these new housing requirements that the state is now pushing communities to build new housing. And it's really hard to execute those programs. There's a lot of community pushback to infill development. There's, of course, environmental review that's very significant and costly and timely. So it's a whole lot easier for developers to build their projects further and further out, where county supervisors typically are very happy to have the economic development, and it's easier to get those projects done, right? So I don't know the answer, but I think it's going to be really hard to build a lot more building in the urban areas versus how easy it is to build in outlying areas. Amy J.
Hi there. Thank you, Rex. I guess just continuing with that line of thought, if you talk about how there needs to be conversation about not just increasing rates, but about mitigation of these problems, I can't understand. Well, I would hope that there would be some notion that there could be input from the insurance industry to say, look, we don't want to have to leave, but if you can keep doing laws that require densification of high fire zones, it's going to make it very difficult for us to stay.
Yeah.
You might want to reconsider that. And I can't imagine that there wouldn't be a lot of clout there, because the state doesn't want to have to go into the insurance business more than it already is, I would think.
Yeah, I think you're right. And I have a slide towards the end to get at this issue. I think we do have a responsibility to be a voice about what is mitigation that's going to make a difference in terms of insurability for a community. I'd like to say we know the answer, but we don't. And we'll talk about the great strides I think we've made in terms of guidance that we would recommend for both home hardening and defensible space at the parcel level. And we did issue guidance last year. We're now in the much, much more difficult phase of coming up with actionable recommendations to guide communities on how to build community resilience, because that's what's driving a lot of the unavailability. A homeowner could do everything right, but still that whole area is uninsurable because of much larger dynamics than the parcel level. And we don't have the answers yet because it's really super complicated. It took about 10 years to figure out in the Southeast what to do for hurricane mitigation. You would think it would be easy, but it's not. What the researchers indicate to people like me is that fire is a whole lot more complicated than hurricane, because in hurricane, all you have to do is worry about things on your parcel. You can button up your home in certain ways, and now we know that dramatically reduces the risk of a major wind loss. For fire, it's different because you can do everything right, but if you've got neighbors, if they don't do everything right, you're vulnerable. But more than that, if your community doesn't do certain things, you're still vulnerable, even if you live in a cinder block home with a metal roof and you have a moat around your house. Your home can still go up. And there was an example in Paradise of a home that was a stone home with a metal roof, and it exploded from the inside because the heat was just so profound when you've got a 100-foot wall of flame ripping through a town. So we know we need to be that voice at the community mitigation level We just don't have the answers yet. We're certainly putting a lot of people under a lot of pressure at the insurance business or the Insurance Institute for Business and Home Safety, but we have more work to do.
And I have a fire department coming to my house every year to tell me what I'm doing right and what I have to change.
Yeah.
And that happens in my whole community. But when you're surrounded by canyons, unless you're literally filling them with concrete,
Yeah.
it's not going to happen. And you're absolutely right about fire being so much more difficult. I think the legislative route is a hugely important one for the insurance company to take, businesses to take on, because it's can I say it's adding fuel to fire? I mean,
Yeah.
it just is so insane because they're literally adding fuel to fire by forcing so many units to be built in those places, and there's no way to get out. That's the insult added to injury. So
Yeah,
I would hope that, yeah, I would hope that those people can rise to the occasion for themselves and for the logic of the whole deal. Thank you.
yeah, you bet. I do feel bad for the developers. You know, you've got people who want to build homes. So it's not that, you know, I think Libby doesn't agree with me.
Yeah,
Go ahead, say your piece.
no, I don't feel sorry for any developer at any time. And I gather you're calling on me now.
Oh yeah, please.
I would just, looking at your chart here, it would be more relevant for me to have 2024 or 2023 rates, because my insurance rates were about they're a little bit higher than what I see for California there, but they have doubled in the last 3 years. I had AAA.
I
I
would love
guess
to
I
give
should
you.
feel lucky because my neighbor, who is a lot wealthier than I am, got his insurance just canceled. And I mean, this whole thing is so insane. The what's his name? Attorney General has, recommended that, cities don't build in high fire severity zones. 46% of my city, Lafayette, is in a high fire severity zone, and I'm in that part. But so they're trying to, but instead of reducing the number of housing units that we are supposed to build in accordance with, how much of the city is in that high fire severity zone, they just expect us to stuff everything in there. So
Yeah, I would love to give you more updated numbers, but we get them from the National Association of Insurance Commissioners, and we're just waiting on more recent data. There's no doubt this average will be higher as we get more data, because we've had rate increases over the last few years. I included Colorado in here just because it was the closest analogous sort of wildfire exposed state that we have. And you can see what happened during this period to Colorado. Very considerable increase. Yeah, Libby.
And I would just, since you mentioned, I wasn't aware of the national flood insurance thing. Why couldn't there be the same thing with fire?
Yeah, it would take an act of Congress, and
Right.
my crystal ball's not perfect, but I know
Not
enough.
this Congress.
I know enough to say that
Snowball's chance in hell.
the rest of the country is not going to be terribly excited about exposing the U.S. Treasury to massive California wildfire risk.
Well, I mean, so we've got Louisiana and Florida and Texas, it's okay. That's okay. But California, screw us. Is that it?
Well, I mean, the flood insurance, I mean, that's how long's the flood insurance NFIP been around? A long time. Who knows if that would pass today? I couldn't tell you.
No, it wouldn't be passed today. Not with this Congress.
But certainly, our membership still believes that wildfire is an insurable risk in California, but that we have to change the regulations that we have here, or else not much is going to change. So, that's why they're not instructing me to go out there and say we ought to be seeking some type of, governmental backstop. They think they can handle this risk, but they have to do so under reasonable terms. And we'll, as the presentation advances, we can talk about what was the overall negotiation that came close at the end of last legislative session, and why we think that it's a viable path forward. And our companies are ready to make the filings that, under this framework that the commissioner negotiated last year, our companies are ready to make those filings, and we can have the prospects for growth again. But under our current rules, we've got to fix those. Tony.
Thank you.
Well, ultimately, Tony Wilkinson from Panorama City. I spent 45 years in the insurance industry, although with Safeco, although it was with the land title division. We're talking property casualty here. But legislation really is the key to all of this, and we can get overly focused, to tell you the truth, on the high fire danger, even though that's a huge issue. Insurance is state regulated. That's the big reason why you're not going to get congressional help here. It's traditionally a state regulated product. And so insurers have to look at every state and they say, what's the legislative environment in this state, including the attitude in general toward pricing, and all the agony of negotiating over this fire danger that Mr. Frazier's talking about is involved with this legislative environment. And we got to admit that we have a uni-party state. And a lot of the people who get elected in the uni-party state have two characteristics. One, since we voted in term limits, they're all short-term focused. And so they want to be elected tomorrow and look good, but they don't worry about long-term health of things like the insurance business. And secondly, they do have, many of them, a social justice attitude that they might as well be running a socialist state. And so they figure we'll just dictate prices. We'll cap prices, for example. Mr. Frazier had the example of the proposition to do so. Well, that just makes people leave. And one of the things that we're not looking at is that high fire danger areas are typically middle or upper middle income areas. But a lot of these things that risk insurance business end up affecting large numbers of poor areas, like my single family residence, typical, but flat San Fernando Valley, that is not over any particular liquefaction hazard. But when you have the general mass resignations with withdrawals from California, like, for example, I was with MetLife for years, and I had real earthquake insurance. I didn't have to do the pool. When MetLife, for these regulatory reasons, decided to leave California, they sold it to Farmers. Thank God it's a decent company. So Farmers is a real traditional old line insurance company. But they decided to simply cancel all their policies in California across the board and write new policies, in this case, to get rid of earthquake insurance, but also to get rid of some things like high fire hazard they may not have wanted to write, and then selectively rewrite policies. So you're already getting massive changes and upsets in the insurance industry, many of which are affecting low-income areas that are not actually problem areas like the high fire hazard. Because the legislator is not taking good care of the insurance market. They're trying to dictate it like a centrally planned economy would. And that's why insurance companies, which are personally, their stockholders are exposed to the risk, they just say at some point, we're not going to put up with it. So I think we have to realize that who you elect to go to Sacramento, and today who you write in Sacramento to advocate for things like a solution to the high fire hazard areas that is being discussed today, that's important because it starts and stops in Sacramento.
Why don't we take Tom and Stu and then hold questions and let Rex continue with his presentation? Go ahead, Tom.
Thank you. That was my comment. Please, people, a lot of us have important things to say, but why don't we let the speaker complete his presentation before we get into all kinds of general discussion?
All right.
Thank you.
Okay, I'm just a short comment, which is and this is something I think that's in common to both flood insurance and fire insurance, and a few other things as well, is that it's going to be affected by climate change. And the problem with the climate change issues is they're a moving target. I've been following this stuff for about 10 years now. That my practice is in environmental law, so a lot of my cases involve climate change. And the fact of the matter is that the risks that you're seeing now in climate change are 2- and 3-fold higher than they were 10 years ago. And that's, again, it continues to move. The Diablo winds, or in the Santa Ana winds in the fall, are now taking more and more time and getting higher and higher and more longer and longer time periods. So the risks keep growing, and it's hard. I would think it'd be hard for the insurance companies to keep up with that.
It's difficult. I appreciate you saying that. I mean, it's hard, first of all, just to understand each company is trying to figure out whether they really understand what's happening. The types of losses, I would say, in the last 10 years that I've seen, they are different. You get hotter, more intense fires that do different types of damage. You'll crack foundations now, whereas 10 years ago, a fire might not do that. Something is different. I think the companies have settled on, in general, with the most observable negative consequence has been a longer period of the end of the dry season with the hot fall winds. Because what's been causing our problems, it's not fires in July or August, right? What's causing our fires or our big problems are when it hasn't rained in 8 or 9 months, and then the big winds come and it's end of November, and then the type of fire you get is just simply out of the control of fire professionals to stop. And what you've done at your house doesn't necessarily guarantee that your home's going to hold up when you've got a fire that's just, I mean, we have to be humble about what Mother Nature produces. And if you've ever been in one of these wind events, and I was in a sundowner wind event in Santa Barbara where there was a fire, I just couldn't believe how hot and heavy the wind was. And the firefighters just had to sit back and watch homes burn because there was just simply nothing they could do. So that is something that's different that carriers are trying to figure out. The three things I think that we really have to get our hands around that are within our control, though, are one, our rate filing process, and that's the relationship between the insurance companies and the State Department of Insurance. Two, not just the pace of the rate review, but the actual provisions of the rate calculation formula. And there's two areas where truly California is the only state in the country that holds on to these two practices. Every other state has moved on. And yet in California, you've got a lot of folks who like things the way they are when it comes to how we look at insurance companies and regulate insurance companies. And so as a result, we've held on to some old rules. Hell, these are two rules I'll talk about that were, they were that way when I worked at the Department of Insurance, and that's been since the mid-90s. And then lastly, the FAIR Plan. We're in a race right now. We're in a race between either we fix this market or we're going to have a devastating fire that the FAIR Plan can't pay for its customers, and they're going to assess these insurance companies, and small companies could be bankrupted and major companies could have their capital position impaired. And we are in a race right now. For rate filings, when you go to the Department of Insurance, these are pretty complicated filings, but in the good old days in 2020, it only took 274 days on average. to get a rate filing through. And this is average. This includes tiny companies that they don't get the scrutiny. When you're talking about companies I represent, they're the household name companies. If they would have taken 274 days in 2020, but they're typically a lot longer for them just because, they get a lot more attention. You get news coverage on these rate filings. And as you can see in 2021, 2022, the number of filings went down, the average approval time went up. And this is in a time of profound inflation. When you're talking about how to make a homeowner's insurance rate, it includes things like, well, what's the cost to rebuild? So if building materials go up, well, it costs a lot more to rebuild a home. If labor costs go up, it costs a lot more to rebuild a home. So when you've got the inflation that we had coming out of the lockdown order, the original lockdown order in March of 2020, pretty difficult for companies when they're facing these increased costs. If they can't get their rates increased, or it takes a really long time, by the time they finally do get their rate increase, inflation has already eaten into a substantial part of the benefit of that rate increase. So they have to go back to the Department of Insurance and ask for more. And then the Department of Insurance gets mad and says, well, why do you guys make so many filings? Why can't you just ask for what you need? It's like, well, if we could get what we were promised in Prop 103, which is a 60-day review time, the language of Prop 103 says any rate application not approved in 60 days shall be deemed approved. And instead, on day 59, the Department of Insurance sends a note to the insurance company saying, hey, if you don't waive your right to an approval in 60 days, we're going to send you to court. We're going to have a rate trial. So which do you want? Do you want to surrender your rights to a speedy result, or do you want to go to rate litigation? And we say, we don't want door number 1 or door number 2. We would like a door number 3, where we can get a quick approval. Because when it takes, upwards of a year to get an approval, companies are going to come right back and ask for more in a highly inflationary environment. So this is a business process issue. To argue the Department of Insurance's side, they're going to say, well, we're in a retirement bubble. There's a whole bunch of people who were hired in the 90s right after the passage of Prop 103 who are retiring now. And then for state service, it's not like, young people are going to college to be insurance rate analysts or actuaries at the Department of Insurance, getting paid state level wages. So they have a hard time attracting new talent. And anybody who's good, guess what the insurance companies do? They poach those good staff from the state and pay them a lot more, right? So, I don't want to make it seem like it's impossible to comprehend the pressure that the state is under when they've got a retirement bubble and they've got a really hard time attracting people. But at the same time, there's a consequence here, which is in a highly inflationary environment where companies are trying to figure out, are utilities going to cause more fires? What's the impact of climate change? What's the role of increased development in high risk areas? They're trying to deal with all these things. They go to the Department of Insurance and it takes a year to change your rates. Well, there's going to be an impact. So we've got to get these numbers down. We certainly, the Department of Insurance doesn't get any taxpayer dollars. It's no general fund money. It's all fees on the insurance industry. So we've repeatedly offered, we'll pay more. We'll help you hire more, whatever it takes so that we can get these numbers down. So we're ready to help them. It's just right now we're in a bad spot when it comes to average approval times. A couple, and I'll go through these briefly because they're technical, legal. There's 2 areas of the rate making formula that are really holding us back. When you make an insurance rate for wildfire, one of the things you do is you go to the state with your actuarial justification. You say, hey, we think that our losses in the future related to wildfire are going to be this. And you tell them whether you think the frequency of wildfire losses is going to go up or down, and the severity of wildfire losses. Are they going to get worse? Or are they going to get less? So frequency and severity of wildfire losses. Well, California is the only state in the country that says, okay, we're going to let you project your future wildfire losses, but you have to do it by telling us what your average losses have been over the last 20 years. And we say, but what happened 20 years ago, we don't think that's a good predictor of what's going to happen next year or in the next 5 years. So why can't we do what every other state does, which is you show your portfolio of properties, you show their proximity to wildfire sources, and you say, well, we do a lot of business in high wildfire risk areas. We think we're going to pay a lot more claims. And you build your future losses based on where you're doing business and where you commit you will do business. That's how we do it with earthquake insurance. You know, when an earthquake insurance company goes to the state, they say, well, we're going to write more business in zip codes that are on faults. So we think our likelihood of a loss is going to go up. And the state says, oh, okay, therefore you should charge more. Or if they say, hey, we're going to retreat from fault lines, the state will say, well, you got to charge less because your risks are going to be going down. We want to do the same for wildfire, and the state so far hasn't let us do it. We're the only state in the country that does this. So we just don't understand how looking backward over 20 years is a good proxy for determining our future frequency and severity. And we ought to be able to say to the state, well, we agree to open up in these high risk zip codes, but we know it's going to produce more losses. So let us charge more so that we can be ready to pay those claims. And to date, the state has said no. So we're not going to get companies going into high risk areas if they can't adequately charge for it. Under the state's rules, a company would have to go into a high risk area, get stung by a bunch of claims, then go back to the state and say, see, we paid a lot of claims, now let us charge more. Companies aren't going to do that. If companies are expected to go into high risk areas, they ought to be able to charge what it takes to serve the customers in those areas. And the same thing on reinsurance. Reinsurance may sound boring or meaningless, but without reinsurance, insurance companies would not be able to serve all the customers they're presently serving. When an insurance company does business, there are rules, solvency rules that governments use, where you can only have a certain amount of premium in force compared to how much capital that you have to pay claims. It's called a leverage ratio. What's the, what amount of premium do you have in force to unreserved capital? Under old rules that were less sensitive, the rule of thumb would be 3 to 1. So you can have $300 million of premium in force. You got to have $100 million in unreserved capital. Now there's more complicated ratios that look at the risk of the business, but this concept of a leverage ratio. So what happens when you finally sell, in this hypothetical, $300 million? Well, if you've only got $100 million, what are you going to do? Most of the insurance is not written by shareholder-owned companies in California. They're written by co-ops. That's what mutual means. State Farm Mutual, Liberty Mutual, Nationwide Mutual. They don't have shareholders. They don't have quarterly investor calls. They're co-ops. They're owned by their policyholders. So if you're a mutual, you can't go out to the stock market and raise money. You don't have stock, right? So you got your 100 million. So once you hit 300 million of premium, what do? Do you just tell your agents, hey, sorry, can't write any more business. I know you were hoping to grow your agency, but sucks for you? No, they don't tell them that. What they do is they take some of the business they have in force and they sell it to other insurance companies around the world, to what are called reinsurers. And when they sell this business, that takes premium off their books. Guess what that does under their leverage ratio? It allows them to keep selling. So that's how the insurance industry is able to serve everybody in California. They're not doing it just with their own native capital. They're doing it with capital from around the world, where we have socialized around the globe California wildfire risk. So reinsurance is just a vital part of being able to serve everybody. Well, what happens when the global reinsurance market experiences price shocks like we have been over the last several years? Well, in California, we say it doesn't matter. So if an insurance company is like, well, I paid X amount of money last year to lay off this business so that I could write more, but this year my reinsurance costs are double. Well, the state says that sounds like a you problem. And the insurance company's like, but I can't then buy as much reinsurance as I did last year because it's more expensive. And their only choice in that circumstance is to pay what they paid the year before, but they get less reinsurance. That means that they have to non-renew a bunch of people because they can't keep that business on their books. Okay. So it's just another choice we've made. where we tell insurance companies you can't reflect your actual reinsurance costs in your rates. And that's fine if we want to take the position that that's an appropriate thing to do. Nobody else does in the country, but we're California, so we're special. But what that means is companies can serve less people. All right, so we've got to fix these two elements of the rate setting method. And if we don't, things just simply are not going to get better. Lastly is the FAIR Plan. And when I hear people say they can't get insurance, I admittedly bristle a little bit, because everybody has a right to fire insurance in California. It's the FAIR Plan. I'm not saying it's the best option, but it's an entitlement. Everybody, even the little pig living in the house of straw, can get a FAIR Plan policy. The FAIR Plan policy is told by the Department of Insurance. They even have to issue policies when there's no roof, when there's no doors, when there's no glass windows. They have to do that. So the FAIR Plan writes everybody, right? And so they go to the state and they say, we're the high risk pool. Of course, the FAIR Plan is going to be more expensive than everybody else because it's a high risk pool. Only people who are desperate enough to go there go there. It would be like in a health insurance context, people with pre-existing conditions. If they had to go to the same pool and only them, well, the price of health insurance for that pool would be through the roof. We used to have that in California. It was called Mr. Mib. We had a catastrophic health insurance program in the state that could give you individual health insurance when you didn't have employer health insurance. And guess what that state program did? It closed because it was bankrupt, right? So the FAIR Plan is a catastrophic risk pool that is always going to be more expensive, but it does importantly satisfy mortgage lenders and realtors and get you through an escrow. It can get you in a house. So the FAIR Plan, it should be always a short-term thing, but right now in some communities, it's the only option. For a while, State Farm kept writing, and from 2017, I think State Farm was 17.6% of the market. At the end of 2022, they were 21.2% of the market. State Farm's the only company that hasn't non-renewed yet since 2017. Every other company has done some non-renewals, some selective culling of the highest risk elements of their portfolio. State Farm has not, and they still have not. And I'm keeping my fingers crossed because we have managed in my high risk area to hold on to our State Farm policy. But if and when they non-renew, I know we're going to be up towards the top of who's going to get it, who's going to get that non-renewal. And then our only option here in Sonoma County is going to be the FAIR Plan. But you can see the FAIR Plan, look at the precipitous growth. At the end of 2022, it was upwards of 300,000 policies. Shouldn't be that high. They're projecting by the end of 2023 that it's going to be close to 400,000 policies. Because once, State Farm's growth is an important thing to take note of. They kept open. Well, first of all, they didn't non-renew anybody, right? So they held on to their business. Then they kept writing new business when everybody else wasn't. And so they started growing uncontrollably. And I understand why they did it. They had a CEO in California who used to be an agency manager. He loves his agents. And he was about to retire at the end of 2022. And he was not going to tell those agents that they couldn't sell more business. He wasn't going to go out of his career that way. And so he kept, growing. And then the new lady, when she took over as CEO in 2023, was probably like, holy moly, what did you just do? Because they had grown an incredible amount and they hadn't taken anybody out of their book of business. And that's why State Farm had to stop writing new business. And it wasn't just in high risk areas, it was statewide. And that tells you it's a capital issue. It's not a wildfire issue. It's that they chose to keep writing when no one else would be doing that. And you can only grow so much before you have to start taking a look at how much business do you have on your books versus how much capital do you have to support that business. And they clearly hit their limit. And so once they stopped writing new business, the next, and they're over 21% of the market, the next business or the next largest company is Farmers. And they're at 15%, already a huge drop off in market share. It only took farmers 1 month to say, hey, wait a second, we cannot take the type of deal flow that State Farm was taking. And at the time, Farmers was writing 7,000 new policies a month, and they had to announce 1 month later, look, we can only do 7,000 a month. And each month when they hit 7,000, anybody with an application seeking Farmers, they get rolled over to the next month. And pretty soon it's going to be like a Taylor Swift concert where on the first day of every month, you're subscribed, because that's how many rollover policies they have. And so with Farmers doing what they can do, there still are companies writing new business. Certainly Mercury continues to write new business. The Northern and Southern clubs continue to write new business. It's not as open as it used to be. But where do people go when the market's constricted in this fashion? Well, where they go is the FAIR Plan. And these numbers show it. And by the time we get through, the final numbers for 2023, they're going to be profound. And why does this matter? Well, so this is a slide that the FAIR Plan presented to the Assembly Insurance Committee last spring. And they were just showing various, in their model of their portfolio, some scenarios for what types of fires could hit. If they do hit in these areas, what would be the FAIR Plan claims liability? And obviously the big orange one is the scary one, Lake Arrowhead, where, 6 months, this is 6 months ago, the FAIR Plan's talking about over a $7 billion exposure. Well, when they did the slide, they had $1.2 billion of capital. Between their capital they hold and the reinsurance they have in place, 1.2 billion, right? So they've got, look at these, possibilities here where you could have a single event where the FAIR Plan is $1 billion or more short for their claims. Well, what happens when they're $1 billion or more short? They turn around to the insurance industry, and all those companies are already going to be paying their own claims for which they've collected premium, and they have to take out of their unrestricted surplus, the money that supports the premium in force. They have to take some of that money and give it to the FAIR Plan. Well, what's that do? It messes up their leverage ratio at that point. Now they have too much premium on their books relative to the amount of capital they have, and guess what they have to do? They have to start non-renewing a whole bunch of people to get their ratio back into place because they had a capital drain, right? So I think, critics of the insurance companies say, oh, isn't this funny? It's unlimited reinsurance, free reinsurance by the insurance industry of the FAIR Plan. Isn't that cute? And they laugh about it. Well, if the insurance companies have to top up the FAIR Plan after one of these events, insurance companies are going to have a major capital drain, and they're going to non-renew hundreds of thousands of policies at that point because they won't have the capital to support the customers they have on their books. So it's no joke if the FAIR Plan is continuing to grow and is going to get us to the point where they have to do a big capital call on the insurance companies, because the money for the FAIR Plan is not going to come from the California Treasury. There's no state liability related to the FAIR Plan. It's 100% backed up by the very same insurance companies that chose not to write those policies in the first place. And that's why those customers went to the FAIR Plan, right? So we're on borrowed time right now, and we are in a race. Is the FAIR Plan going to take down this industry, or are we going to make the changes that we need to make so that companies can, they can fix their capital position and ultimately begin to do more business in California so they can depopulate the FAIR Plan and reduce this terrible risk that we have facing us? Obviously, rating agencies are starting to take a look at this. A year ago or 2 years ago, rating agencies probably didn't even know what the FAIR Plan was. Now they do. Now they're starting to ask companies when they're looking at how they're going to rate them, well, what kind of FAIR Plan exposure do you face? So we can't ignore this FAIR Plan issue. Lastly, on mitigation, I know I've gone on long. At the parcel level, the major insurance industry research operation, the Insurance Institute for Business and Home Safety, IBHS, they are to property insurance what the Insurance Institute for Highway Safety is, the crash test dummy people. That's the insurance industry that funds that research. So what the insurance industry has done to advance the state of the research on auto insurance, they also do on property insurance through IBHS. And the fellow who runs IBHS, used to run the National Flood Insurance Program. Really, really smart guy. He's under a lot of pressure to advance the state of science for home mitigation. They've done so, and they put out what's called wildfire prepared home guidance. The city of Paradise was the first city last year to require all new home construction to adhere to the wildfire prepared home guidance. And we were talking earlier, we know we have a responsibility to play in giving some standards to decision makers about our suggestions for building. We know we do. We take it seriously. We've done that at the parcel level. And now Roy Wright, the head of IBHS, has been directed, you got to do the same for community mitigation. Because we can't have a state of affairs where everybody, they do what's right, they sink a bunch of money into home mitigation, and then they feel like, okay, I should be insurable, and then companies say no. I'd be mad, and I know others are because I get the complaints. But we've got to get to the point where insurers give better guidance on what can communities do to make that home safer. And it's hard because if you've got major hillsides or you've got major ravines, those are, terrible risk factors when it comes to the threat that a fire could play for a community. So what do you do? How much vegetation do you need to take out? Is it going to change the characteristics that make that community so attractive? For, Libby's example, Lafayette, it's a beautiful green area, beautiful trees. But how much of that vegetation would need to come out to demonstrably reduce fire hazard? And that's what we're trying to answer. I wish I could tell you what it is now, but we don't have the answer yet. And that's what IBHS is working on. But we're not going to get out of this situation until we start to get some consensus at the community level for what it's going to take to lower community risk. Because otherwise, we're just going to be paying more and more claims. Those claims costs are going to drive higher rate levels. People are going to be paying more premium, and it's not going to be sustainable. So we can't just look at higher rates as the answer. We've got to look ultimately at bending this cost curve down and coming up with a better approach for community mitigation. So with that, I've yammered on enough. Rick, how do you want to proceed?
Any comments on the state legislation last year, where things went and where they might go this year to help alleviate the problem?
Yep. There were fairly advanced negotiations toward the end of last session that arrived at what the commissioner has called a sustainable insurance framework that looked at rate approval times. They looked at allowing the use of modeling and reinsurance. And they looked at what to do with the FAIR plan in exchange for new restrictions on insurance companies where they have to write in higher risk areas. So that framework, it was pretty much done, but ultimately the assembly didn't pass it. And the commissioner, with backing from the governor, announced in the fall that they're going to pursue this by executive action. And so we're on pins and needles waiting for the Department of Insurance to issue draft regulations that would allow companies to use the two factors that I mentioned, modeling and reinsurance, to have some guarantees for quicker time review. But the state has indicated they'll only allow the use of these new rating tools if the companies commit that they're not going to shy away from high risk areas. And so obviously our members don't love restrictions, but I think they've accepted the fact that the commissioners put these conditions out there, that if companies are arguing that use of these two new rating tools will increase their ability to serve high risk areas, he wants to hold their feet to the fire and put restrictions on them and make sure that their rate filings to use modeling and reinsurance include information on how they're going to write in high risk areas and how many policies they're going to take out of the FAIR plan. So we're ready to go. It's just a matter of when the Department of Insurance is going to put those draft regulations out so we can start debating this publicly. Does that answer your question, Rick?
Yeah, I think so. Thank you. Amy, you have a question?
I do. Are there implications if a foreign reinsurer holds policies in case of massive fires?
End screen sharing, please.
What? There are extensive regulations under the California Code of Regulations for the types of reinsurers that our members are allowed to do business with. So they're called the Credit for Reinsurance Regulations, and those foreign reinsurers have to be real. This has to be an arm's length transaction, documented, adequate credit, all of that. So there is an extensive regulatory regime for it. Rick, oh, we don't.
Yeah, somebody asked me to into the screen share. I think they wanted to see you, so
Oh, okay.
I just did that little maneuver to end your screen share.
And so, what you'll hear, Amy, is, there's lots of folks who want to hold up the specter of, spooky, foreign companies that we can't trust, Lloyd's of London or whatever. That's just not the case. This is an ordinary, boring, run-of-the-mill part of the insurance industry that's functioned for a very long time. Reinsurers, we certainly don't have, experience with reinsurers not honoring their contracts. So that hasn't been a worry for ours, but, anyone who's going to be a critic of ours, they're going to point to things like, shadowy global reinsurers and say that we ought to be scared of them. And that's just not our experience.
Well, I understand the ordinary boring part of it. And up until a couple of years ago, that was, as your chart showed, basically what the home insurance industry looked like in California.
Yeah.
That changed, as you showed also in 2017 and 18.
Yeah.
And if there are massive fires, which, if we look at climate change, which the legislature is clearly not really addressing either statewide or countrywide or worldwide for that matter, then that stops being boring and the same. And
for sure,
that's my concern.
Yeah, I think you're right to be concerned. We haven't had problems with reinsurers paying their claims, and certainly I can tell you in 2017 and 2018, the global reinsurance market sent a whole lot of money to California.
Okay.
And now in 2019, imagine if you're an executive at one of these reinsurers and you're thinking, what's my end of the year bonus going to look like? Is it going to look better if I bring in a lot of California wildfire business? The answer was no. And so reinsurers started requiring the primary insurers, our members, to pay a whole lot more money in order to get their help. And that caused a huge problem. So we haven't had problems with their claims payment. We've had problems because they're organized under the laws of another state or another country, and California can't control that. All California can do is control the amount that companies here pay. So while our state says we're going to cap your premiums here, your rates here, we say, okay, we understand. But as those reinsurance costs around the globe go up, they're not controllable by California. So how do we address the imbalance, right? It's certainly not easy, but it's a real verifiable cost that these insurance companies here pay. And if we want to act like in the rate formula, those rate shocks don't have an impact on insurance companies, well, we're going to get what we see, which is less availability from the insurance companies.
Thank you.
Okay, I don't see any more questions. Vicky, go ahead.
Oh, you're muted.
Great presentation. Thank you very much. I have a comment and a couple of questions. Here in Siskiyou County, I think we have the second lowest median family income in the state, and we're a very extreme fire risk area. I think one of the things I'd like to see is an overlay that's presented to HCD for the RENA numbers so that the insurers are actually telling them, do not push more housing in these areas, particularly the density bonuses, which allow you to go to double your vertical density if it's downtown, if you have 20% affordable. That means that in our community, which does not have an adequate fire protection system with ladders to handle 5 stories, we have a 3-story, 45-foot limit. It is in effect pushing us into a very high risk condition. And I think if the insurers and insurance companies would push on HCD to make some allowance and actually take a look at this with an overlay, it's a very simple thing to do. And particularly in a community with such low median family income, having your insurance double is just not tenable. And there should be some way of grandfathering in the, people at a certain income level, I would think. But the way of avoiding the problem to continue and exacerbate is to actually stop pushing the densification and intensification in these areas. And then my question is, you didn't list USAA on your group of insurance companies, and I'm wondering what percentage they have of California, and also, do you think it's you're in a better position if your mortgage is in the hands of that company, such as USAA, as well as your insurance? Do you think that in some way protects you from having your insurance canceled?
Yeah, I mean, USA is a terrific company. They write about 4.5% of the market. As far as your mortgage lender is just looking, do you have an insurance policy that adheres to what's called the standard form fire policy? The state of California has a definition of fire insurance. Each fire insurance policy, whether it's through the FAIR Plan or any of the admitted insurance companies, has to meet certain minimum standards for what it will cover. And insurance companies are not allowed to carve out things and issue a policy below the minimum. So for instance, if companies said, well, we'll write one-off home fires, but we won't write wildfire events. Well, state law prevents that. Every insurance company that does business here, including the FAIR Plan, they have to write wildfire because it's part of the standard form fire policy. So whatever policy you get, whether it's from USAA or FAIR Plan or anyone else, it's going to meet those minimum standards, and all of them are going to satisfy mortgage lenders.
But do you think there's a chance that you're in better shape having your mortgage with your insurer?
I don't think I understand the question. I mean, as long as your insurance policy satisfies the lender requirements, you're good. Maybe I'm just dense and I'm not catching your question.
Okay, I thought some people I know had their insurance canceled with no claims for the last 20 years. And they're in the same high fire risk area that I am. But USAA has not canceled me, fortunately. And so I'm just hoping that they will say, well, we have her mortgage, so we've got to have her.
Oh, I see what you're saying. Yeah. There are a lot of decisions that feel unfair that people face, where insurance companies, they're making a decision unrelated to that particular parcel. So, when a company, let's say, doesn't have enough money to get the same amount of reinsurance that they got the previous year because their quote from the reinsurer has gone way higher, well, they get less reinsurance. That means they can handle fewer customers, and they're going to go into their portfolio and they're just going to look at policy by policy what is the riskiest policy in the portfolio, and they're going to surgically say, well, I can reduce my projected liability by 30% if I just excise this 1% of policies. And those are the calculations they make because of issues like this reinsurance thing. And so it could be a policy where the customer, they've done everything right, but there's a big hillside right by them, or there's a big forest, or there's a bunch of chaparral around them, or a bunch of ravines around them, and that community dynamic gets them knocked out. That's the problem where, at some point, I think we have to be able to tell communities, look, what's driving the uninsurability in your community is this part of town where there's all this vegetation, and if you reduce X% of that vegetation, you'll bring your community back into insurability. We don't have the ability to speak at that level of granularity yet, but that's what we're shooting for. Oh, Rick, you're muted.
Mary Eliza.
Hi, I have a couple of what may be dumb questions, but I have some history of having worked with an insurance rating company, so I have a little bit of understanding of some of this. You mentioned Lloyd's of London. They started out to be an insurance company. Now they're a bank. They're a huge bank and insurance company. They're still an insurance company. I didn't even know they were still. So what is the relationship between the banks and the insurance companies? And also, how does the investment part of the insurance business affect what their bottom line is? The ones that can invest some of their cash in the market.
Yeah, there's extensive rules for investment. Typically, the most liquid class of business is auto insurance because big companies are paying thousands of claims a day, right? So you have to be highly liquid. If you're a life insurance company and you're holding on to people's money for 20 or 30 years and they have an annuity, the state allows you to invest in all sorts of other long-term things. You can even hold more real estate, for instance, which is not easily liquidated, just because the nature of how you have to pay is so different, right? So for wildfire, you can hold a little in equities, but generally you're going to get more money market CDs, those types of investments. You don't get huge investment yields that you can do. If we were to allow companies to invest in more equities, if they were able to generate higher returns, then rate levels could come down commensurately. That's the way the rate formula works. But there's not a huge number of folks who are clamoring to allow wildfire insurance companies to invest in a lot more equities and face the volatility that comes with that, when what you really want is safe and secure companies who are going to be able to rebuild your home after a wildfire. For companies like Lloyd's, I just said that because that's a name most people know, but there are reinsurance markets in big cities around the world and small, whether it's not just London, it could be Geneva, it could be Dublin, it's all over the world. Company folks, it may sound glamorous that they have to travel to all these different places and do these reinsurance transactions, but they always report to me it's quite the grind. Because you're just in a conference room haggling over a reinsurance contract. The relationship between insurance and banks, it's not something I really focus on or as part of my daily work. There's very particular state rules for the conduct of insurance business in California, and it's not really dependent on banking issues. I'm going to be speaking with the Mortgage Lenders Association next week, and what they're really focused on is are the insurance policies going to be adequate to protect the collateral that they've taken. So
I had one other question. And that was, I'm sorry, I forgot it. I'll have to come back later.
no worries.
I got so involved in listening to what you were saying that I forgot what my other question was. Thank you.
Not a problem.
Tom, you're up.
Thank you. First of all, outstanding presentation. I think perhaps the answer to the question she was looking for is that there is a high degree of separation between banks and insurance companies, and there are many larger parent organizations that handle both, USAA being an example. But there is a great deal of separation between the insurance and the bank aspects. There are some times where that has failed to some extent, but that's the general rule, particularly for the larger organizations. Again, outstanding presentation. There are a number of very fine questions in chat, and I might suggest you might want to go through some of those. You've covered a lot of them already, but there's some very good questions there, I think, that you could address. Thank you.
Awesome.
Stu, you're up.
Hi, Rex. Tremendously good presentation. It very informative and fascinating, if disturbing. One of the things that strikes me is listening to Vicky's comments about her county. And yet we've got the legislature continuing to do this one size fits all legislation on housing. And they try in some cases to put some caveats on it and say, well, this won't apply in very high fire risk areas unless you do the following. And the following often is a very wishy-washy thing. Well, you have to do something to take into account the high fire risk, but it does nothing compared to what really needs to be done in terms of, as you point out, there needs to be tremendous efforts at the community level for mitigating these hazards, particularly as the hazards are continuing to increase with the advance of climate change. And it just strikes me. I know you do some lobbying in the legislature.
We do.
Which I'm very grateful, because we need to have somebody explaining to the legislature the impacts and the effects of what they're doing. And maybe they need to be spending more time thinking about how do we incentivize mitigation of fire risks, rather than how do we continue to just densify communities that maybe are not in a good place to do that densification.
Yeah, my gut feeling is once we come out with our recommendations for community mitigation, where there's clear metrics, and I don't know the vocabulary yet we're going to use, but if we're able to say, X% of vegetation in this part of a community, let's say, my sense of the willingness of the legislature and the administration, grant money would fall out of the skies from the state down to HOAs and cities and counties if everybody knew for sure that money, if it were used to do mitigation, would make communities more insurable. I have no doubt about that, which is why I think we have this responsibility to give people clear guidance on what it's going to take to make a community safer and face less insurance hazards. So that's why we're pushing so hard. I do think there'll be good cooperation from Sacramento once we have a better game plan for where and what type of mitigation do we need to execute. In my mind, the much harder thing is going to be the community discord that's going to come, because there's a whole lot of communities that aren't going to want to do what the insurers would recommend, because they like the life the way they have it, and I think that's going to be the much harder thing, particularly when lawsuits ensue. If there's going to be a game plan to take out vegetation in a certain area of a community and some people don't want it, I think that's going to be the way harder issue.
Yeah, it is clearly going to be a big one. One other thing I want to ask you about, there's a group I've heard of and followed some presentations from called First Street Foundation. Are you familiar with them? And
I know that they have an approach to hazard evaluation. Yeah,
exactly. And it seems like what their approach, which is kind of a looking at all the possible risks and evaluating them, and they do this on a national level. But it seems like that type of an approach might be a helpful one for the insurance industry to present to the legislature and say, you should think about this.
Yeah, we worked on 3 or 4 years ago, having a statewide model of insurance risk. Bill got all the way through the legislature, and I think the Department of Finance prevailed upon the governor to veto it simply because of money issues. These are the vagaries of Sacramento.
Kim, you're up. Hello.
Thank you. Yeah, I was kind of listening to Vicky's saying too, but my question is kind of very local because I'm a small thinker in terms of this fire thing. In the area that I live in, Los Angeles, it's a very low risk fire area, but the surrounding areas are high risk fire areas. So my question is, are the premiums of a low risk area put together with the high risk area fire when your insurance premium? So this is very small thinking, because I'm just kind of wondering, because my insurance policy went up but we're not in I'm in a low income neighborhood or community in Los Angeles, and my insurance policy went up
Yep.
because of the high risk fire zones that surround the area, but it's not real close.
Yep, I hear you. So under the law, the technical legal answer is that low risk policyholders are not supposed to subsidize high risk policyholders. Now, when insurance companies go to the state and say, okay, you've authorized me to charge this amount statewide, and this is how I'm going to distinguish among customers, typically there is pressure from the state to make sure that people at the very tippy top of the risk profile get their premiums pushed down a little bit for affordability. And what that does is it because companies won't collect as much premium from them, they push that premium down to lower risk folks. That does happen. A technical reading of the law says it shouldn't, but that's just the reality. And I guess I can understand why people at the Department of Insurance, are sort of trying to balance these equities. That's not the way the law says it should work, but that does happen.
That my policy would subsidize these high risk fire policies.
I believe that does happen, yes.
Which is unfair and untenable, but
well, I mean, it's against the law, technically, but it's not like insurance companies are going to sue the state of California over it. Imagine the kind of proof you'd have to put on, and a judge's head is going to be spinning looking at all these different facts and figures in an insurance, rate filing. So I don't know that we can do anything about it, and I do believe it happens. But under the law, it shouldn't.
Okay, thank you.
Christy.
Thank you. Great presentation. We really needed to hear all of this. I live in a high fire area. Can you comment on the lack of CAL FIRE maps in high severity fire zones for cities and towns? Why has it taken 2 years to delay us getting that information so we can act on that information with mitigations? Yet the CAL FIRE maps for the public land has come out for the state, and they've started their mitigations because they have the information. So that's my first question. My second question, can you comment on FireWise communities? Do they get more grants? Do they get more availability to fair insurance rates and guaranteed insurance companies to cover them? Thank you.
Yeah, the first one's it's the politics of it are fascinating, related to CAL FIRE hazard maps. So when we talk about insurance risk, that's a different concept than hazard. Hazard is the natural landscape. Insurance risk, you're looking at other things that are not necessarily the natural landscape. So the CAL FIRE maps are supposed to be showing you fire risk related to the natural landscape across California. And when those CAL FIRE maps first started, think about their origin, they were to guide local land use decisions. And so any areas that were already built, they were not actually given a designation because they were already built. And the goal of those maps was to guide, well, if a city wants to permit here or there, they might look at the maps and say, well, that's a really fire hazard area and this isn't, so let's authorize over here, right? So there's significant parts of those maps that just have never had a hazard designation or a hazard rating applied to them. So we lobbied for years, along with many other people, to change that so that the CAL FIRE hazard maps had to rate everywhere. Because what we learned in Coffey Park was it's not just undeveloped areas that can be sources of fuel. If a fire gets into a community, once a house catches on fire, that house becomes fuel to cause another fire. So there has to be a more robust designation of risk in these maps. Well, as you can imagine, CAL FIRE, they have to do this, but they're not super eager to put out a new map that then is going to cause a bunch of problems. They don't want to get the blame, right? So it took over 12 years for them to update the hazard maps, which they just did a year or two ago. But we were banging on them, as many were, for a long time. And it got to the point where insurance companies no longer even used the CAL FIRE maps because they were so out of date. So on the bright side, we assured CAL FIRE when they were considering putting out their new hazard maps that we're not going to go out there and blame insurance rates or underwriting decisions on them, because it's long time since insurance companies have abandoned using those maps, and we don't really use those maps. So there's a whole robust industry of vendors that help insurance companies look at hazard in the natural landscape that's not, part of CAL FIRE. So for us, that hasn't been a thing. I mean, we think they're valuable, and hopefully, if they're able to keep them up to date, they can become part of regular use by insurers. But right now, they're not really a major part of our business. Now, FireWise community is an interesting concept. Companies generally provide a modest recognition of FireWise community because what it represents is a community's stated intent to start talking about these issues. Not every FireWise community is the same, right? Some are barely functional, others are quite robust. So there's no real minimum standards for what FireWise communities would do on a daily basis. But insurers want to encourage the behavior. They want more FireWise communities to exist. And as a result, they uniformly would recognize FireWise community designation in their rate filing. But just because a community is a FireWise community, they can still burn down. Fountain Grove, which is above Coffee Park, it burned down. And that was a wealthy community that had the FireWise designation. And their problem was they are on the front lines of a big canyon that, like a bellows, the wind was flowing through there, hot, dry wind. Once the fire started, they're on the front lines. And, it was unreasonable to think that fire wasn't going to go through Fountain Grove. But in the Department of Insurance, last April, all companies had to comply with a new Department of Insurance regulation where they had to specify mitigation discounts and a whole range of things. And recognition of FireWise communities was in that regulation.
Okay, thank you. I did have a good friend lose her house in Fountain Grove, so this is a hot issue.
It is.
Mhm.
Kelly?
Yes, I'll just make a quick comment. Thank you very much. I just feel like from listening to the presentation and the discussion afterwards that we really haven't grasped how fires have changed and how there is really no fire safe area. And I just finished reading the book Fire Weather, and I would highly recommend that to anyone who is concerned about fires. That's about the Fred McMurray fire in Canada. So do you have any comment about that? I just see that we're in big trouble.
Well, I think we are in quite the fix. We just have a bunch of things that have combined where now we're finally waking up to it. Whether it's, we had 100 years of generally a policy of not allowing fires to burn. And it's understandable. We all grew up with, put out the forest fire, Smokey the Bear, all that sort of, or Smokey Bear, as my wife says. It's not Smokey the Bear, it's Smokey Bear is what she tells me. There's a lot of liability or a lot of worry that government agencies have with allowing fires to burn. Who wants to be blamed for allowing a fire to burn and then it gets out of control and then someone loses their house or a community goes up? Nobody wants to be that fire captain who allowed that to happen, right? So we haven't generally allowed the acreage to burn that 500 years ago would have naturally burned. And certainly in the West, we have fire adapted species. I mean, I live in a redwood forest, and it's a fire adapted species. So we're on a landscape where we used to have a lot of fire rolling through. Certainly, when you talk with Native American groups, they had an approach to fire that was more friendly than adversarial. And fire was used for a lot of beneficial purposes. One was just to reduce insect infestation. There's a lot of good that happens with fire because it would take bark beetle populations and reduce them and then keep the forest healthy. It also would kill smaller diameter vegetation and allow trees to grow a lot bigger, the fewer remaining ones. So we have fewer straws in the ground drawing water and they grow up to be more majestic trees. So there's a lot of good that comes with fire, and we've put a dampener on that. At the same time, we've allowed a whole bunch of development in areas where we don't allow fire to burn. And so before you know it, we wake up and we have all this valuable property in areas now where we can't really let it burn because there's too high of a risk of homes going up in flames, right? So then instead of having controlled fires, now we have uncontrolled fires, uncontrolled carbon release. And none of that's good. So getting back to the point where we can have community agreement on what should be our goal. Should our goal be through a combination of controlled burns and mechanical thinning, try to get to a vegetation or tree density that more resembles what nature would produce in the absence of our involvement? My personal view is yes, but I know there's lots of people who don't agree with that. I mean, certainly the community I live in, there's no agreement on touching a single branch in our forest. So that's why I think the hardest part of this is, even if we do come up with standards, I think there's going to be lots of community acrimony on people saying, let's not let those damn insurance companies ruin our community. They can't tell us what to do, and we're not going to do what they want. I could certainly see those fights. Vicky.
I'm wondering if two things, a comment first. Back in, I think it was 1980, in reaction to Thousand Oaks putting through a slow growth initiative, allowing the community for the infrastructure to catch up with the housing crunch. One of the developers, Chappelle Industries, decided to put through two bills, which were considered to be the worst bills that had gone through the state in 20 years.
That's saying something, because there's a lot of bad bills.
Or very bad bills. A representative who was the lobbyist for 18 years, that this was going to race through. The Democrats are going to push it through. It was their major fundraising effort. And I couldn't believe it. I had always voted Democrat. I had no idea that this was the case. But I did find two honest environmentalist senators who were willing to work on the problem of defeating these bills, and it ultimately took a gubernatorial veto. One of those bills was that it would allow any parcels to be subdivided, no minimum acreage of 1 unit per acre in the highly forested zones, or 20 acre minimum in the very high risk areas. They would allow 1/4 acre parcels. And of course, the fire department reacted to that. So we were fortunate that at least they took a stand. I don't know that it made a difference because it did take the veto. They used it as their main fundraising, as I said. But is there a list of bills that the insurers are watching? Because as everybody has said, with Weiner in the state and many of his colleagues, the Democrats are just pushing on housing. And that bill was defeated only because of the gubernatorial veto. Brown was on the right side in that period. And it took a lot of effort, letting all of the areas that had beautiful, highly forested areas, literally stood in Sacramento and called every single environmental reporter in every newspaper to tell them what was going on as that was happening. And that kind of thing is happening now. And I think, with the densification, intensification, the insurance industry has a major role to play with CAL FIRE to comment on these and not take just to sit back and watch what happens. They have to weigh in. And I'd like to see a list of the bills that you're following.
Yeah, I appreciate your perspective. I don't know that our members are ready to do that yet. I'm just being honest with you. They're trying their best just to get their house in order, and I don't think at this point they're looking to pick huge fights with powerful interest groups, whether it's builders or others. I don't think there's consensus in Sacramento on what to do about housing. We have a new Senate president. He's from a relatively rural area. He used to be chair of Senate Local Government Committee, so he knows these issues well. I think he was a supervisor maybe before he was a senator. And, he's had bills looking at restricting development in high brush areas, right? Meanwhile, you've got all this pressure for new housing, right? So, but that's really, coming out of the executive branch now. So I don't think there's consensus yet on what we should be doing. And I think if someone earlier was saying they don't have, they're not going to cry crocodile tears for developers. I'm not suggesting I will either, but at the same time, I understand what they're trying to do, and they're trying to build more houses, and they feel like they're stymied at every turn, and they want to build more. But they feel like they have to build in areas that are going to exacerbate our insurance problems. So if it was easy, people would have already taken the steps. The problem is none of this is easy. Sandra.
Hi, yeah, just a follow-up question. It's basically the same thing. I live in San Diego in an area which is within the footprint of the Normal Heights 1985 fire, which was a national disaster. We live on the Canyon Rim. It's a very high fire hazard severity area. And they're putting like 10 ADUs next door on a single family lot. And, it's a difficult situation for us. And the question really I'm asking is, might these community standards that you're developing include not putting density like that in the wildland urban interface? And how does density like that, how does that typically get factored in when setting insurance rates for the neighbors?
Yeah. When IBHS finally develops their community mitigation standards, my gut feeling, and mind you, this is still well in process, my gut feeling is there is going to be one dimension of it that looks at building concentration and building density. I think what they're going to do is to come up with a concept where one measure of community preparedness is what percent of a dense area what percent of the homes in a dense area have met the parcel level designation that they've already put out. So this wildfire prepared home standard, it's a suite of things that you have to do all of them. You can't just pick and choose a la carte, because an ember, if you don't put a mesh on your attic vent, but you do 5 feet non-combustible zone around your house, well, great, you've done the 5 feet, but the ember still gets in your attic and burns your house down, right? So the parcel level mitigation standards that IBHS produced, I think one concept in their community will be, is there a certain threshold, kind of like with herd immunity? Is there a certain level of parcel level mitigation that changes the community dynamic and prevents a fire from being able to jump from house to house like Coffee Park? So I do think that will be part. It won't necessarily be density. It will be more what percent of a community has done the parcel level mitigation. That's my sense of a housing related thing. Beyond that, I think they're going to be looking at trying to put some measurement around fuel density and topography is my guess, which won't be related to home density.
Thank you.
Yep, did we lose
We're
Rick?
going on 2 hours here, so let's make Vicky the last question and go ahead, Vicky.
Okay, I'm just, since you weren't here last week, I initiated a conversation about smart meters. Because a lot of the fires, such as Paradise and Santa Rosa, were involved with smart meters. So you have a situation where they're not really wildfires, they're called wildfires, but they're actually electrical fires caused by the way the smart meters are connected to a hub. And that's why you saw that rock-faced building explode from inside. And until that is addressed by the insurance industry, and there are specific regulations and identification of these fires as smart meter fires, we're going to have a continued problem with them always being identified as forest fires when there are living trees right next to the house that's burned to the ground. Thank you.
Yeah, I do think that when we put out community mitigation standards, they're going to be standards that look at subdivision context versus rural context where homes are further apart. And I think there'll be different recommendations for the context of the parcels for sure. Rick, you've worn me out.
That's only because you've such a wealth of information that people kept having questions for you, and we so appreciate your coming today, and great presentation, Rex, and great information in answering the questions, and just thank you again for being our guest today. You've done a wonderful job of educating people on insurance that we didn't even know what we didn't know. So thank you.
My pleasure. Really, really happy to do this.